And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa!
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. Are you nuts?
With your host, Phil Grande.
Bye. Thank you for joining my podcast again today. I really appreciate you doing that. Hope you tell your friends so they'll also come to our podcast, because this is the only place you're going to get the truth. This morning, again, the PCE, what a bunch of BS that is. PCE, not too hot, not too cool. You know, that's a scam. Wall Street needs that to mask what they're doing so they can get those big fees. So I'll explain that in a moment, but also what people don't realize is we are really due for another crash. Since 2008, we've been averaging every 4.5 years a crash, where we've gone down an average of about 40%, and 40% of a retail trader's equity, they lose about 40%. Same as about what the market goes down. Every 5 years, 4.5 years, like clockwork. Go back and check the 208, how many crashes we had, I think 4 or 5, and you go out in a timeline, it's every 4.5 years. It worked past due. So that's something that's very important to watch, especially we're seeing now that we're running out of oxygen. We have the worst breath in the world. We only have 7 stocks, 12 stocks at most to hold up the whole stock market. That's insane. So you can check it out and you'll see we're right. Now, more BS from Wall Street today. PCE, not too hot, not too cold, inflation is just right. What a bunch of BS. And they get away with it. Because you know why? Because traders look at one thing. When they look at their chart, they look at the right-hand column where all the numbers are. I better get in at 200 before it gets to 205. I better get in at 210 before it gets to 211. That's all they care about. They have no idea what's going on. That's why 95% of traders lose money every day. So the PCE, they came out and said, not too hot, not too cool. Why do they do that? Why do they BS us? Why do they lie like that? It's Wall Street. And it's the White House and Congress. They got to BS us. So let's talk about the biggest fees, okay, come from management fees. Wall Street needs inflation to be underestimated, like today, because that sets them up. If inflation is underestimated, and they say, well, inflation's calm, not too hot, not too cold, that sets them up perfectly. Allows them to keep buying the indexes. Now, I'm talking about the S&P and the Qs. Now, they're not allowed to buy these indexes if inflation was high. So they lie. Why do you always think the White House is always saying, this is the strongest economy ever in history, when we got the backbone of our economy, small businesses, just getting trashed? And small businesses provide the jobs, not Apple, not Microsoft, not Tesla, small businesses. So going back to Wall Street, the gangsters, as long as they can tell you there's very little inflation, it allows them to keep buying the indexes. Why do they do that? Because when they buy the indexes, then they manipulate, how they manipulate is saying that inflation is not hot or cold. But when they buy these indexes, that's where they make their money. That's how they get so rich, so wealthy. So, and they need the White House to back them up and say the economy, we've never seen an economy like this. It keeps the fee machine going. It's always, Wall Street's always about fees. Fees. That's what it's about. So today, when they said inflation's not too hot, no cool, they're lying. That's all BS. It's a big lie. Just go to the grocery shop and still go get your gasoline. Go to the drugstore. Go anywhere you go. It's a lie. But it's a lie they need, or they can't keep buying, putting people in their 401ks, piling them in with more index money. I mean, just think about it. They control, right? When you look at what they control, the big boys, Wall Street, right? As they always say, you got 12 institutions, but 6 are the big boys. They control $60 trillion, all right? So these guys, okay, BlackRock, Vanguard, State Street, Fidelity, T. Rowe Price, Capital Group, they control, let's say, $60 trillion, and they control about $13 trillion for the stock market. So they control all the money that's in 401ks. They control all the money that they get and manage for pensions. They control all the pension money in GM and Ford. I mean, they control all of the pension money. Sovereign wealth funds, they control them. So when they control all this money and manage all this money, they can't say that there's inflation. They got to say there's no inflation, or it's cool, or it's not hot, just right. Like you're cooking a bowl of spaghetti. Are you nuts? If they don't say that, they can't go in and keep shoving money into your 401k. They can't keep shoving money, moving money around in your 401k. So what happens is people keep putting money in their 401k. When everybody says, hey, the inflation's not too hot, not too cold, everything's great. The White House says, boy, the economy's so fantastic. We've never seen an economy like this. And people sit there and keep piling money in their 401k. That's why it's to keep the fee machine going. As long as you can say there's no inflation, it's not hot, it's not cool, the fee machine keeps going. When the market sucks and it's no good, it appears strong. Exactly what's going on now. When you have no oxygen in the market, you have 7 stocks holding up 700 stocks instead of 300 or 400 stocks holding up 700 stocks. Give me a break. So when the market looks strong, it's not. But all they got to do is lie like they did today, and people will keep putting more money in their 401k and keep putting more. And then when the market crashes, which, by the way, every 4.5 years since 2008, and we're due, and they just pile in money in 401ks, they're going to lose 30 to 40% of it, about 40% on average, and the crash is coming. People keep buying ETFs. I remember the days when ETFs came out. And Wall Street, oh, don't buy ETFs. You're going to lose your eyesight. It's like shorting, right? Don't short a stock. You're going to lose your firstborn. You're going to go blind. Now all they do, the whole market's ETFs. Everybody's in ETFs. And as long as they hear that inflation is not too hot, not too cold, then all those financial shows, all the TV jibber jabbers on CNBC and Fox Business and Bloomberg's, they can always come out and tell you everything's wonderful so that you'll keep your money in your 401k. You'll keep buying ETFs. You won't withdraw your money. It's a scam, so you won't withdraw your money. They lie to you. So you won't panic. People never, 65 million people trade every day, retailers, they never question what anybody says on CNBC or on Fox Business. I can't remember the name of the fellow on Fox Business. He always gives a free book out. Oh, I can't think of his name. Charles something or other. It's a scam. Remember what I always told you. Wall Street is designed, only they can win. Remember, you have a buyer and a seller. Only one person wins on Wall Street, and that's Wall Street. Retail never wins. You're going to get wiped out another 40%. And while you're putting all your money into 401ks, you have no idea how bad the economy is. You have no clue. But now by saying today it's not too hot, it's not too cool, then all the jibber jabbers on CNBC, Fox Business, Hannity, oh, he'll get out there tonight, Hannity, oh, everything's wonderful, oh my God, you see this? 401ks are up 30,000. No, they're not. That's a bull lie. I heard him say that again the other night. My wife, my Marta had to calm me down. I got so mad. I said, what does Hannity do? Does he get a little note from the White House what to say? 30,000, it's a lie. The average 401k, which you're going to give back, is only up about 9,000, not 30,000. I think 9,000 is great. Why lie about it? Well, they don't want people to withdraw their money. They don't want people to panic. So now the jibber jabbers on Fox for the rest of the week, oh, they're going to be talking about no inflation, no inflation. Really? So a strong market equals steady fees for Wall Street. So you got BlackRock and Vanguard and State Street and Fidelity and T. Rowe Price and Capital Group all getting fees. That's how they have a house in Aspen. They have a house on Nantucket. They have a house in Switzerland. All these fees. They don't care if the economy's weak. Wall Street doesn't give a crap if the economy's weak because all they have to do is say there's no inflation. And all you have to do is get the president to say the economy is the best ever. We never recorded an economy this good. It protects their balance sheet when they lie, when they tell you there's no inflation. It protects their balance sheets. The asset management fees alone are over $1 trillion per year. If you say there's inflation, they don't get that $1 trillion per year in fees. They get that $1 trillion in fees because they're taking the money, okay, from your 401k, they're taking money from the sovereign funds, they're taking money from your mutual funds, they're taking money from teachers' unions and car unions, and they're piling into crap stocks. People don't know that. People don't know that. They don't know that in tech there's only a few stocks holding up the whole market. They don't know. Total Wall Street pulls in fees, just the fees, not anything else. $1 trillion a year. You can't pull in $1 trillion a year if you say, inflation's hot. You can't, Wall Street will never allow that. Unbelievable. You know they make on average just advisory fees, $500 billion a year in advisory fees? And they know nothing. They know nothing. These people on Wall Street, only the guys at the top. Everybody else is like a herd, cattle. And so remember, when these indexes rise, when the Qs go up and the S&P goes up, the collateral looks stronger. So the collateral in your 401k looks strong when it's not. So since 2008, every 4.5 years, the market crashes, and we are due. You have no idea what's going to happen to your 401k. I mean, when you sit there and think about it, you have margin accounts, we talked about this the other day, average $250 billion, $350 billion, all these years. all these crashes, we're over $1 trillion. $1 trillion. Do you know what's going to happen when they start calling margins? When stocks start going down, the margin calls are going to be huge. We've never seen anything like this. People are going to be panicked, dump, dump, dump. And remember, we got stocks right now, and I gave you these numbers the other day. This is how wacky the market is. God, I wish everybody would just learn how to short and make a fortune. So to build a position, you used to get 100 shares of Microsoft. All you had was 5,500. Today, you got to put up 50,000. You buy 100 shares of Apple, you put up $2,500. Now, Apple 100 shares, you got to put up 30,000. So you see what's going on here? So these stocks are incredibly overpriced. And they justify all their stories they tell you on air every day by some fundamental. Return on assets are terrific. Return on equity is terrific. They always make a story and throw some used fundamental. They always use some fundamental. Price to book or price to sales are terrific. Free cash flow is really terrific. So think about this. So they do this, make sure inflation is not too hot, not too cool, so that the risk models look stable. A strong index like the Qs and the spiders mask all the risk. If SPY drops 20%, banks suddenly look fragile, right? If SPY rises 2%, everyone pretends everything's fine. It's just, what a bunch of gangsters. You see, it's unbelievable. I mean, it's a dirty game in which the retail investor, the tourist investor, gets hurt. Anybody in the stock market does not know how to sell short. Means you got to be buying to perfection. And while you're sitting there with your 401k and everything else, you think you're making money, you're not. Because underneath it all is quicksand. But that's okay if you know how to sell short. I mean, the two stocks we're mostly in, the two stock groups, we're in three stock groups every day, mostly the same three stocks, oil, tech, and the banks. Because that's where all the money is. Why do you want to be in materials? I mean, other than gold, okay, miners, we buy those. You know, why would you want to be in discretionary stocks or leisure stocks? All the money is in three groups. So when the market looks good, it's not. And that's why they got to lie and say inflation is not too hot, not too cold. And then institutions keep selling into strength. I tell my gang members that every day. When we get a big rally, sell into it. And when you buy on a sweet spot. Look at your stochastics. When they hit 30% on the bottom, that's where you buy. Stop buying at the peak. But remember, the retail investor always buys at the top, at the peak, because he doesn't even know how to give a stock a 2-day test. He has no clue what I'm even talking about. Unbelievable. Banks will sit there and offload all their garbage on you. Put it in your 401k. You don't know that. And then you got the insiders cashing out real quiet like. And everybody thinks, oh, look at that. Inflation's not too cool, not too hot. Wow. And in the meantime, they're pushing the cash out the door. Give me my cash, give me my cash. The guys on Wall Street. That's why you can't beat Wall Street. And anybody doesn't know how to short a stock, how are you going to win? You got to trade to perfection. How would you drive a car with no reverse, just forward? You wouldn't do that, but they do that every day in the stock market. This is why they love buying indexes, because they can mask what's going on. When the big, giant players, the 6 biggest managers, keep buying indexes, it lifts everything up. lifts everything up. All boats go up, right? It creates an illusion of strength. That's why they buy these indexes. That's why I always tell my members, always stay in the spiders. Never be out of the spiders. Either be short the spiders, be long the spiders. Because you'll always make money. If that's all you ever trade is the spiders, and you know how to go short as well as go long, you will never, never not make money. Never. Because you're playing the index, but you're going to be on the same side as the gangsters on Wall Street. They love buying indexes because it masks all the dirty stuff they're doing. And it makes the market look strong when it's not. It creates an illusion of strength when it's not. And it gives them a lot of cash so they can get out and leave you with the bag of crap. And the other thing, Wall Street, it keeps Washington off their back with regulations. That's right. I mean, Washington, especially when a new president comes in, the first thing they do, remember when, what the hell is his name? Biden came in. I forgot what the numbers, I thought I had it here. It was interesting. But when Biden came in, he raised regulations. I mean, it was crazy. Instead of, let's say, this isn't the exact number, but you get my point. Instead of increasing regulations, like every president comes in, increase regulations by, let's say, 20%, he increased them like 1,200%. And that's what Wall Street doesn't want. But they'll leave them alone as long as the index, they keep buying indexes and it makes the market look strong, they'll leave them alone. That's another reason why they keep buying the Qs and the spiders. And that's why you got to be in these. You got to know how to go long and short. See, Congress won't ask questions as long as the indexes are up. And that's why, again, when Trump keeps saying, this economy is the best ever in the world, Wall Street doesn't have to worry. They're not going to get regulated. All the regulators go home. They go home for the year. They go home. They don't even go to the office. As long as they look and see indexes are up, they don't regulate anything. They go to sleep. When the market goes up, everybody shuts up. All the crookedness, everything that's going on, just like now. Nobody's ringing the bell saying, hey, wake up. Since 2008, what's that, 18 years, I think? We've had every 4.5 years a crash. We're at a 4.5 year point. Nobody's saying a thing. Nobody's saying anything about it. What are you, nuts? So, remember, all you will hear is soft landing, disinflation, all these key words. Resilient consumer. These are all the key words they use. Goldilocks, that's one of their favorites. Strong labor market. That's all BS. But they use those words, those narratives every day to play you. And you won't learn how to short. You think you're okay. So when the market drops, those narratives collapse. That's why they won't let the narratives collapse. That's why they keep buying, pension funds. They keep buying more and more the indexes. They keep buying the spiders and the Qs. As long as they keep doing that, the market's going to keep going up. But guess what? We're running out of time. I'm running out of time here too. So again, the market right now, okay, it's time. I mean, it's time. If we don't get a correction here shortly, then the days, I mean, this is only a few years ago, 2016, right? 10 years, nothing. You could build a position in Microsoft for $6,000, 100 shares. Today, it's going to cost you, as I told you over and over, you need $50,000 for 100 shares. This is not good for the stock market. What else isn't good for the stock market? Is the margin money. We're over $1 trillion. So we can see clearly what's going on. We got all these time bombs clicking, ready to blow up. And what does Wall Street keep doing? Buying the indexes. Keep buying more Qs. Keep buying the spiders. Oh, wow, look at, boy, the economy's strong. Look at the market. Every day, all you hear on CNBC or Fox, okay, especially Fox, another all-time new high, another all-time new high. And somebody's sitting home with his 401k, doesn't even look at it. When it comes in the mail, he throws it in the drawer. Well, Joe Suckface on Fox just said everything's wonderful. All-time new high. Every day we're getting an all-time new high. The only real highs going on, the guys on Wall Street sniffing cocaine. That's the real highs. So the PCE, it's cool, all right. Not high, not low. And what nobody understands, the liquidity in the market's drying up because the institutions are pulling their money out. That's another thing people don't get with the stock market. There's 10 to 12 trillion in the stock market alone. There's 60 trillion altogether. They allocate about 10 to 12 into the stock market. And all that's in there, left in there now, is about 1.3 trillion. That's it. There's no liquidity. No liquidity. It's unbelievable. We have no follow-throughs with these rallies. We have no breakouts. When's the last time you've seen a solid breakout where you consolidated and broke out? Consolidated and broke out. Those don't happen anymore. You don't have any momentum. I mean, it's amazing. And all the hedge funds keep doing is reducing their exposure because they know what's going on. They know what's going on. So that's it, okay? So as long as you know how to sell short, as long as you know how the yields work, yields are your truth serum. Yields are your compass. It's never wrong. It'll always give you the correct direction of the market. If a stock is going up, right? It's going up and up and up and up, and you look at your compass, and yields should be going up, but they're not. They're going down. It's telling you, keep taking profits because this thing's going to drop like a flying whale. So that's it. All right. So again, I'm not here trying to scare you. I'm just giving you some reality, trying to tell you something nobody else wants to tell you, especially CNBC and the rest of them. Unbelievable. So the average drop since 2008, every 4.5 years, has been about 39-40%. People lose equity in their stock. It wipes out 40% of their gains, especially in your 401k. And so again, check it out. We've had a crash every 4.5 years. All right, that's about it. The only stocks that are really doing well right now, and they're having trouble, and when they have trouble, you got a real problem. Okay, those are the software stocks, okay? Let's just see what's going on. Let me see if I can catch them here. Where I let you go. Those are the cloud stocks, okay? Like CRM. They're all pulling back a little bit right now. NOW, WDAY, Adobe, Intuit. That pulled back big today. CRM. But when I say pull back, don't panic. Because if you look on your chart and you look on your Pro 1, you see that it's a swing trade to the downside. So you could be shorting that if you've been with me long enough. But the trend on your Pro 2 straight up. So if people are jumping out of the stock because Intu went down today, why are you doing that? Because your trend, your stochastics are up and it reflects what the candlesticks are doing, and it means the candlesticks are solid. There's plenty of money still going in. All right, so that's the only ones. Those are the relative strength group. That's really it. That's really it. That group. Everything else is a disaster. But it's beneficial because if you know how to short when this market tanks, man, it'll be a holiday. All right, that's it. So thank you for joining me on my podcast. I always try to just give you the truth, okay, the way it really is. And it's not political. I don't talk politics, okay. Do I think Trump's a great president? Yes, I do. I mean, he does some very, very stupid things. His ego gets in the way. Okay, I mean some real stupid things, like starting that White House, right? The ballroom without having all the permits and the permission. Why would you do that? He's in the development business. You don't break ground until you got that last permit in your hand. I couldn't believe when he did that. Unbelievable. All right, I'm just jibber jabbering now. I'll see you on the charts. Please join me again on my podcast tomorrow. We have fun doing it. I enjoy doing it for you, and I'll always tell you the truth. See you on the charts.
Are you nuts?